Welcome, everybody. Thanks for joining us for another edition of Living Beyond the Numbers podcast. I'm your host, Jude Boudreaux, with Caleb Arringdale, our Director of Positivity. And we're joined today by Rob Boehner, who's the head of our tax group, one of our partners here at the Planning Center, and really a colorful and interesting character. So welcome, Rob. Glad you're on here today.
Yeah, thank you.
Yeah. So, Rob, we've gotten to work together for a long time, but maybe shared a little bit about how you came to be a part of the Planning Center.
Sure, absolutely. Well, I'm a graduate of the University of Iowa. I did my undergrad and my master's there in accounting. And I came back to the Quad Cities area where I grew up after college, joined a full-service public accounting firm where I did quite a bit of audits of nonprofits and taxation of various different kinds of entities. And I knew Matt Sievertson very well growing up, and through that time, we're musicians together, and eventually started chatting with the Planning Center and ended up joining the team back in 2015.
Yeah. Well, and Rob's head of our tax group, and I often jokingly say, like, it's hard to find accountants who are good at talking to humans, but our accounting team is all really good at that. And there's a big part of the kind of the planning experience with us to be involved in conversations and what's happening with clients throughout the year, not just doing taxes in the spring. So, Caleb, maybe you want to take it away, since you guys work so closely together.
Yeah, Rob is my boss. So I guess first of all,
oh boy,
I'd say, obviously you and Matt Sievertson played in a band for many years together. Why is it, do you think, so many people here at the Planning Center are musicians, and like musicians at like a pretty high level?
Yeah, I think it's really cool. I'm not sure why, but I do know that music can just create this special experience. It can really give you a lot of meaning in different areas, whether it's the community aspect, the conversation aspect, or that pursuit of a discipline and mastery, or exercising those different sides of your brain for different things. So I think that just can work well at people, working together.
Yeah, I mean, in music, you're in an ensemble usually, right? If you're in a band, you're in a group, and that's what we do as well. I totally agree. But, as much fun as music is, let's talk taxes. I mean,
Sure.
So obviously the current tax thing is this new tax law, right? Do you want to tell us a bit about it? Give us kind of the quick rundown. Like, what is it?
Yeah, absolutely. So the new tax law, the One Big Beautiful Bill, or the HR1, it's been called a few things, that was passed back in July. And so we've been really getting to work on studying that and understanding things. Some things we're certainly waiting for clarity on, but have really been able to start grasping some of the key points and planning ideas around that. So I think one of my biggest takeaways is, back in 2018, we had that Tax Cuts and Jobs Act passed, and that was a pretty big change compared to the 2017 laws. And a lot of this new bill is just going to extend many of those same provisions. So before this bill was passed, we had a reality where maybe some or all of these Tax Cuts and Jobs Act provisions would be gone after 2025, and we could see a reversion to 2017 rules in 2026. That'd be a pretty big change. Now, almost everything, or many provisions, are simply extended, slightly expanded, slightly changed. So I'd say for a lot of people, it's kind of a continuation of the norm that you got used to back in 2018.
Yeah, I totally agree. I had a tax school instructor say that the old tax law, the TCJA, that 2018 law, was like someone put a trench coat over the old tax law, so you really had to know both. Whereas now we just have like one tax law. So in some ways it's probably slightly simplified, but there are also a bunch of new provisions. So I guess thinking of 2025, right? Well, what are the biggest changes for this year that are in the tax bill?
Yeah, I think the few key things to keep in mind, the first one is that when we claim a deduction on our tax return, either we get a standard deduction, which is around $30,000 for married, filing, joint, or we get an itemized deduction, which can be a culmination of a bunch of different things. For example, if you have a lot of medical expense, that might add to your itemized deductions. If you have mortgage interest And if you have state and local taxes and charity, those are the main ones. And usually medical isn't high enough to be included in that anyways. It has to surpass a certain threshold. And so one of the biggest changes here is the state and local taxes deduction, also known as the SALT deduction. That was limited to $10,000 back in 2018 with that TCJA law. And this new law is going to expand that deduction up to $40,000 if you're under income limits. So for certain people who have high enough SALT or state and local tax deduction to help them itemize instead of claiming the standard deduction, and if their income's not over the limit, they might see tax savings from this higher deduction.
We heard a lot about this whole SALT cap. It was a lot of discussion. What taxes are part of this? What's actually included in SALT?
Yeah, so SALT includes your real estate taxes if you own your home, and it also includes your state income tax if your state has an income tax, or it can be state sales tax as a deduction instead of the state income tax if it's higher.
Perfect. The other big thing that got bandied around a lot was the idea that like Social Security would not be taxed. How does the law actually describe that? Like, what's actually happening?
Yeah, so moving on to the next big change is that one where we have this new deduction that's called the senior deduction. And it is not necessarily related to Social Security income. It is a deduction you could qualify for if you're age 65 or over, whether or not you've claimed Social Security income. So it's not tied to that in any way. It doesn't impact the amount of Social Security that is included in your gross income. And that's also separate from your itemized deduction or your standard deduction. So whether or not you itemize or claim the standard deduction, you can get this new senior deduction if you're age 65 or older and if your income is under certain limits. So not everybody is going to qualify for this deduction as well. The amount of the deduction is $6,000 per spouse who is over that age limit. So if we have somebody just under the income limit, which starts to phase out at $150,000 of income for married, filing joint, they would be in the 22% tax bracket if they're both age 65 and over. So they get this deduction and they're not phased out of any of it. The maximum benefit is $12,000 times 22. And that is about $2,600 of maximum tax savings.
Any other big deductions? Any other changes for 2025 we're looking at?
Yeah, so I think there's three more that are also all deductions that I think are worth mentioning. Not going to be applicable for everybody, but we have that tips deduction. They talked a lot about the no tax on tips. And so what this is, it's not taking tips out of your income. Tips will still be part of your income. It's a separate deduction that you may qualify for against your income. So that's more important for determining things like what is your total income or what is your adjusted gross income. So kind of a technical thing. But if you have tips income and if you're under income limits, you could get qualified for that deduction up to $25,000 of tips. But I think a really important thing to keep in mind is I know a lot of people are like, ooh, I could just say everything's tips or build in mandatory tips into my income stream or whatever it is. And there are going to be a lot of rules, or there are a lot of rules that are going to limit kind of the gaming of that system. And it's only going to be applicable for industries that regularly have tips as part of that industry. I believe the IRS is going to release a list of these industries. So I wouldn't count on people getting particularly creative to take advantage of this deduction unless it really is the nature of that income.
Yeah, so no tips for your tax professionals, right?
Yeah, exactly. We can't say, hey, 30% tip on a tax return, guys. Oh.
Yes. Yes. So yeah, a lot of people cannot say, I'm going to reduce all of my fees by 80% and now charge a whatever tip on top of it. That kind of thing won't fly, of course.
Bummer. No.
The next deduction would be overtime deduction. So if you're under income limits, all of these new provisions or most of these new provisions have income limits. So not everybody will qualify, but overtime will have a deduction as well. Similar to tips, overtime would still be part of your income, but you'd get a deduction that you could qualify for it's only the like and a half component. So when you get overtime pay and you have a higher rate of pay, only that increase in your rate of pay can be eligible for deduction, not all of the pay that's for the overtime hours.
Got it.
So the third one would be this car loan interest deduction. And that one's also a little misleading. It's only new cars as of 2025 onwards. So your old cars that have loans, that interest would not qualify. And there's rules about being assembled in the US. And I think they're going to have a website, or they might already have a website where you actually look up the VIN to determine if that vehicle's qualified for this deduction. And this deduction, just like the senior deduction, the tips deduction, and the overtime deduction, none of these are itemized deductions where you only claim them if you itemize. They're separate from itemized or standard deduction. So you would deduct them in addition to your standard deduction or your itemized deduction.
No, great. Obviously, this has been, thrilling for a tax person. So for non-tax people, this can still be pretty impactful. So this is pretty good stuff. Finally, so that's the big things 2025. I'll say, what about 2026? Anything we're looking forward for next year?
Yeah. Just before I move on, one other just overarching comment is that all of these provisions that I've talked about so far, I think for the average client of ours, usually it's going to have a modest impact rather than a really significant impact, except for there'll be very specific situations where they might be in that Goldilocks zone for one of these new provisions. And then that type of person might see a significant benefit. So that's something that we're always looking at proactively with the work we do with our clients.
Yeah, I think it's important to hit on that too, though, because I like to tell clients we want to make tax-aware choices and not tax-driven ones, right? So going out to buy a new car might be fun, but it's not, and it may maybe save you a little bit on taxes, depending on, if it qualifies for these provisions, but it's not enough to say like, well, you should just go buy a new car for tax purposes.
Yeah, and then I guess now let's move forward to 2026. Yeah.
Yes.
What are we looking like?
Yeah. So there's quite a few more provisions in 2026, and I didn't cover everything in 2025, just kind of the highlights, the most important ones. So I'll go through a little bit of a laundry list of 2026 of what I think might be the key things to keep in mind. So I think one is that under the old rules, the estate exemption was going to go down after 2025. And with this new law, the estate exemption is going to instead essentially increase, but as if it were inflation adjustments to the old 2018 rules. So we're going to have a 15 million estate exemption beginning 2026, making what this relates to is estate taxation. So if we have an estate that's worth 15 million or less, most likely you would not be subject to federal estate tax. And that's also per spouse. So if we have a married taxpayers and one of them passes away, or we'd have 30 million total between the two of them. If one of them passes away and if they file for the what's called DSUI, deceased spouse's unused exemption, then that deceased spouse's exemption can be claimed by the surviving spouse in the future, leaving the surviving spouse with a estate exemption of 30 million under current law. And again, these laws can always change. So it could be 15 million now, and you don't know what it will be when you might pass away. So there's always an element of uncertainty the longer term we look.
Yeah, I think that's an interesting one because for like years now, we haven't really worried about that. For most people, not too many people have estates over $30 million. But for those who were, obviously it was a big deal, but most people aren't above that. But if it had dropped pretty pretty precipitously, all of a sudden this would have been interesting again. A lot of planning would have had to be done, but this really simplifies it.
Yeah, I think it just speaks to that there will always be some uncertainty about the bets we're making now are about things that may not occur for 30 years. And so it just always takes some intentionality around the decisions we make. And a surviving spouse may not be particularly interested in filing for this DSUI because there's a cost and a process to that. But let's say 30 years down the road, for some reason we have a estate exemption that's very, very low. They might wish they had filed for this exemption.
I know I'm familiar with a situation where a family is going through and filing this exemption, and it's a bit of a process to do with the estate attorney and the tax folks to get all that recorded. But it's just an ounce of prevention for a pound of cure. If the exemption changes dramatically, when I started in the industry, the estate exemption was $500,000. So it was a very common thing for people to be dealing with estate taxes, and probably unlikely that we maybe head back there. But I also imagine it's maybe unlikely we're staying in this $15 to $20 million range for a very long time either. So I just think if a family has means, it's wise the investment of energy to file that DSUE and make sure you've got that exemption in your pocket.
Yeah, absolutely. So then kind of moving on to some other provisions in 2026, the next ones are all around itemized deductions.
Sure.
So moving on with another charity item is some of our itemized deductions, like medical, are subject to what's called a floor in taxation, where they're reduced based on your income before the excess amount is included on your itemized deductions. So medical, as an example, is reduced by 7.5% of your income before it is included in your itemized deductions. Beginning 2026 with the new law, our charitable donations will be subject to 0.5% haircut or floor before they're included in itemized deductions. So if you had a adjusted gross income of $100,000, then your charity would be reduced by $500 before the amount over that is included on your itemized deductions. So a little less tax benefit to charitable donations in 2026 from that floor rule. And then similarly, for higher income taxpayers who are in the highest tax bracket, the 37%, there's going to be a new provision in 2026 that reduces the tax benefit of all of your itemized deductions based on the best way to say it is as if your itemized deductions were deducting at your 35% bracket instead of your 37% bracket. So that little mathy there, but basically makes it so you can't get the benefit of your 37% bracket on those deductions. You get a cap of a 35% benefit, saving 35 cents on the dollar instead of 37 cents on the dollar. So overall, 2026, we have a few provisions that are going to give us a slightly reduced benefit to itemized deductions for high income taxpayers.
Yes, I think that's part of maybe the planning opportunity that people should explore with their tax professionals is, is it better for me to give in 2025 and perhaps give more than to give in 2026?
Yeah, I think that's a great point. I'd love to expand on that a little bit. I'd say that for those who are really considering large philanthropy gifts in any time soon, if you want to consider funding a donor advised fund with a very sizable donation, or if we were looking at pairing some strategy such as recognition of income with an offsetting charitable donation strategy, commonly we might see Roth conversions being considered for this type of strategy, then 2025 is going to be a little more tax efficient for most people to complete these charitable goals than 2026. And this plays into another concept called lumping. So lumping is when, let's say, the standard deduction is around $30,000 and my itemized deductions are usually around $28,000. So I get no benefit of those itemized deductions each year because they're just slightly too low. With a lumping strategy, you might consider condensing multiple years of those deductions into 1 year, so it rises way above the threshold to itemize instead of claiming the standard deduction. And then in those other years, you are claiming the standard deduction. So charity is the most common way to accomplish that. You might do 3 to 5 years worth of charitable giving goals in 1 year, whether to the charities or to a donor advised fund. And then in those other years, you're dripping money to charities from the donor advised fund, or have already met your goals from via the current year donation. And that kind of gives you a tax savings over a longer period of time.
And the long story short on that is, if you want to do that, maybe consider 2025. 2026 is still good, but yeah, this year, talk about the potential of accelerating that.
A little bit better tax break this year for most people.
Any other big 2026 items?
Yeah, absolutely. So these won't be relevant for everybody, but it just depends on circumstances. But we have a variety of other things. One is 529 plans will become a little more flexible for how they can be used. And what a 529 plan is it's a tax preferred savings vehicle for college, essentially. But now it's a little more flexible. So you contribute money to a 529 plan, and you have a beneficiary such as your child or grandchild. Commonly, you get a state deduction for that contribution, depends on the state. And then that grows tax-free instead of the earnings being taxable every year. And as long as it's used for qualifying expenses, those distributions out of the account are also tax-free. So that's a great way to fund college. And now we'll have a little more flexibility beginning 2026. Another item is that most of the energy credits that we've had for a few years, some of them for longer, most of those are repealed as of 2026. So ending in 2025, the electric vehicle credit ending even earlier, September of 2025. So we won't have most energy credits in 2026 onward. We also have, for those on the state health insurance programs, the bronze plans will now be eligible for HSA contributions. And a HSA is a health savings account. If you are in a high deductible health plan, then you could contribute money to these HSA accounts, and it's a deductible contribution or a tax-free benefit from your employer. Now they're going to include bronze plans, which are technically not high deductible health plans, into the eligible type of plan for these HSAs. And that the employer dependent care benefit is going to go up from $5,000 to $7,000. So if you have an employer dependent care benefit program, basically that's the employer contributes to the saving, or can pay or use part of your salary to pay for dependent care costs for your children. That amount's going slightly up, so you can get a little better tax break there. There's additional loss limitations on gambling income, making gambling even more tax inefficient. They don't have very good lobbyists. So that's going to come into play for some gamblers. They're increasing the business meals deduction. This is for businesses, from 50% to 100%. So get a little better deduction for business meals. And one other one that I think is kind of interesting for some people is we've had these 1099s that we sometimes have to file if you're paying somebody more than $600 a year in your trade or business. You have to issue this 1099 NEC or 1099 MISC, miscellaneous. Though that threshold is going up from 600 to 2,000, so have less of these forms being issued. There's also similar rules around 1099Ks for people who have all of those online transactions and credit card transactions. Those reporting thresholds are also going up. We'll see fewer of those forms issued.
I think it's kind of a sleeper, but I think that's actually one that could be really interesting for people. Just because for some people who are paying someone, $700-800, and they're always like, "Oh, do I have to fill out this form?" And we're like, "Yes, you do." Now they don't have to. And there's a surprising number of people kind of under that $1,000 limit. So I think this actually will reduce some compliance costs for people. So that's kind of a benefit for several people, actually.
Yeah, it's fascinating.
Yeah.
One other item that could be its own topic and would be for later, but they have this new Trump account as part of the legislation. And we're waiting on quite a bit of clarity from the IRS on how exactly Trump accounts will work. But for now, the best way to think of it is beginning next year, 2026, it will be a potentially tax favored savings vehicles for newborn children with a variety of rules around how contributions work, how distributions work, what it can be invested in is limited. And we're waiting for quite a bit more guidance to see exactly how that's going to function and when it might make sense and when it might not.
Yeah. And, I think that's a good point because obviously those Trump accounts are a great example of this, but so many of the things we've talked about, we think we know how they're going to work, or the IRS has issued limited guidance on it, but we really don't know yet. There's so much gray area out there still, so much we're waiting on actual rules, actual instructions and tax forms on, that some of this stuff we're just going to have to wait and see how it really plays out. So we've taken several classes, we're trying to learn, but some of it, literally, there is no law yet. So I guess we'll find out, hopefully shortly.
I think it's always fascinating because you have the law that is kind of the guideline, and then the rule-making packages that go out from the different agencies are this kind of additional part to the law, but it often gives us the details we need to really understand something.
Okay, so we've talked about all these different tax provisions. In your experience, for like the typical family, what sort of planning strategy should they keep in mind? What are the new ideas about that?
Yeah, I think one of the most important points to keep in mind with the new law would be that many of these provisions have income-based phase-outs. And so what that means is, like, as an example, this new SALT cap, the expanded deduction for state and local taxes, phases out over 500,000 to 600,000 of income, of modified adjusted gross income. So, and then the same goes for the senior deduction, has a phase out range, its own phase out range. The tips, the overtime, many of these provisions have these income phase out ranges. So if you are someone who's in or near one of these phase out ranges, and if you're planning around income recognition, whether that be selling a stock that has a lot of unrealized capital gain, or considering a Roth conversion strategy where you trigger income now as part of a long-term planning process, these phase outs can cause magnified tax rates on these income events. So we have to be careful about saying, what is a person's marginal tax impact of this income event? It might not just be their marginal tax bracket that they're in. It might be higher because of some phase out. They're already phase outs under the old rules. A great example is if you had the qualified business income deduction and other circumstances, then that could phase out over a certain range. Or the taxability of your Social Security income. If your income is low enough, none of your Social Security income is taxable. And then you get into what's called the Social Security bubble, where it's becoming taxable up to the maximum 85%. So whenever you're in one of these ranges, your marginal tax rate is not wherever your income lines up in the brackets, it's higher than that. So that's going to be really important for considering opportunities for income recognition. A lot of sources of income, you don't get to decide anything. It's set. You have to take your required minimum distribution. You can consider charity out of that to reduce that. You have to take your Social Security if you've already filed. You have to take that pension, your wages, you usually have to take. So a lot of income sources you can't really plan around, but there are some income sources that come about from planning, and it'll be important to keep in mind these phase outs when thinking about the tax cost.
Yeah, agreed. We've always had some of those, but they've gotten much more magnified.
Yeah.
It opened a little window there too. Is with about qualified charitable distributions. Are there any changes to that concept as we look forward?
I think they become only just as good or better because the itemized deductions can be subject to this overall limit if you're in the highest bracket. And charity has this new 0.5% floor, making charity slightly less efficient beginning next year if you're itemizing. So charitable donations directly out of your IRA, if you are otherwise qualified, you have to be 70 and a half to the day. It can't be the year you turn 70 and a half, and other rules. There's limits as well to the total amount you can give each year, but that's always going to be, or almost always going to be, the most tax efficient way to meet your charitable goals if you're otherwise qualified for that. And these new rules only reinforce that because now we have more income phase outs to consider, and it can only help those income phase outs in addition to everything I've also just discussed.
Yeah. Any other big planning tip?
Yeah, I alluded to the idea of charity being a little more beneficial for most people 2025 compared to 2026. I also just wanted to speak to the general notion of lumping as it speaks to not only charity, but sometimes there's an opportunity with lumping around medical, although sometimes that's pretty limited in what you could do with that. Sometimes there's an opportunity around your state and local taxes, but that's also needs to be navigated. Sometimes you don't have a lot of choice around the timing of your state and local taxes as well.
Yeah, perfect.
And I do have one more as well, actually. We also have, we have an expanded 0% bracket for folks who are 65 and older with this new senior deduction. So you have a lot of folks who are age 65 and over. They have Social Security and their other sources of income are not high enough so that their Social Security is not taxable at all. So you might be able to look at something like a Roth conversion in some scenarios and pay zero amount of tax on that Roth conversion, or you might have some other opportunities to trigger income from a variety of other sources. And you'd have a wider range in that 0% bracket before that Social Security bubble and that actual tax brackets really kick in because of the extra senior deduction.
Yeah, that's another one that could be really powerful for people. Like overall, I think these have been great. I mean, this has been a great breakdown. There's so many provisions. If your eyes have completely glossed over during this whole thing, I would say, well, that's why there are tax accountants out there. So don't worry, we've got you.
Yeah, I think that's for folks seeking out advice, that's the great benefit of it. You can rely on people who really enjoy digging into a lot of these provisions and understanding how it works and get excited about finding ways to see what happens if you choose A or choose B. It's a fun thing for many of us in this space to play around with. Well, all right, Rob. Well, I know we're coming up to time here, so I've got a few rapid fire questions we like to ask everybody who joins us. So first is, what is your favorite animal?
I'm going to go with a turtle.
Okay, nice. Does that have a specific meaning for you, or just something you've always stuck with?
For some reason, just growing up, had some predilection to the turtle. I had a pet turtle briefly, and it did run away. That is not a joke.
Okay, wasn't something that your dad sold you on or something?
No.
Right. Okay. All right. So, what do you think it's always worth spending more money on? Is there an item or a thing you think is worth spending more on?
Ooh, that's hard. I guess I'm going to go with experiences because experiences are so important to living.
Yeah, no, I'm on board with you in that one. If you had to say the best money you ever spent, do you have a thought on that?
Yeah, I do. On the website, I listed this as well, but my electric toothbrush changed my life many years ago now, but it was the best money I ever spent for those healthy teeth.
So if I told you to buy some happiness, what would you do? What would you buy and how much would it cost?
That's great. Well, this is kind of relate to experiences, but I'm a skier. It's my happy place is Copper Mountain, Colorado, and so I'm going to go with the lift ticket. We have a piece of art in the condo in Copper that says, "You can't buy happiness, but you can buy a lift ticket."
I like that a lot. That's not a skier, really grew up, down the bayou here. There's no mountains, no snow, but I can see very much how that would fit. And that's pretty cool. All right. So travel wise, we're talking about experiences, favorite place to visit.
Yeah. Would say Copper Mountain. I've already mentioned it. It's not fair, but
yeah, no, I was going to say, I think you need to give us like another, if not Copper Mountain, is there somewhere that you'd like to go?
As far as like bucket list trips, for me, it would be Scotland, Ireland, or New Zealand.
Okay.
Those are two I'd love to go to. I'm very blessed. I've done a lot of travel, and I have not been to either of those places.
Nice. Well, that's exciting. It's always good to have things to add to the list. Tell me about the last achievement you celebrated, and how did you celebrate that?
Oh, sure. Yeah. So actually, I turned 40 this year, and something clicked, and I've really stepped on the gas for exercise and being active. So I've been running or biking almost every day. I set my personal record for a 5K I think this week. So being active, feeling healthy, and really celebrating that.
Nice. Well, that's great. And that's one of those good long-term investments too. So that's fantastic. Thanks so much for joining us today. It was really great to have you on here. And thanks to all of you for listening. Please, follow the podcast and subscribe. And we'll have some resources in the show notes for you to be able to get in touch with us or follow up on anything else that you might like to know.